Welcome to Smash Avo Property. Today I'm speaking with Dilleen, who has such an inspirational rags to riches story. Although he is still very humble and wouldn't call it riches himself. He's a 28-year-old with 16 investment properties, and he walks us through his early childhood and how it inspired him to buy his first property at 18. Eddie is also kind enough to talk to us in depth about his strategy that led him to acquire 16 properties, utilising multiple lenders, different entity structures, and ultimately brings it down to two main issues, either equity or serviceability.
Like I got up to like 8-9 properties and I was on average income. I was probably on lower than normal. So generally every property I've bought has always had a yield above 7%, generally every single one, no matter what. And I guess as long as the rent, I'm not personal circumstances, but as long as the rent covers everything, and like it's either an issue with the equity or it's an issue with the servicing.
As always, seek your own professional financial, legal, and property investing advice for your current situation. Everything we talk about is just our opinion and general in nature and should never be considered as personal advice. So without any further ado, let's get house hunting with Eddie. Dilleen, welcome to Smash Avo Property.
Thanks very much, mate. It's great to be here.
Yeah, I've been waiting to get you on for a little while. I've sort of been following your journey a little bit and heard you on a couple of other podcasts and sort of watched your story unfold over the years. So I'm really excited for this one. I think the listeners will be too. But to get us started, why don't you talk about what inspired you to get into property and how old were you when you started?
Yeah, sure, mate. I guess I first got interested in property when I was a teenager, and I pretty much grew up in a really poor family. So like I grew up in Western Sydney. Mum and dad never owned a property. Grew up extremely poor, really. Like no one in my family owned a property at all. So when I was a teenager, about 14, 15, it was at that time obviously going to school. I realised that no one in my family owned property, and speaking with friends at that time, I realised that one day they were going to inherit properties, and I wasn't really going to inherit anything. And I growing up from that kind of circumstance and that kind of situation, I learned at a young age that I didn't want that for the future. So I really became very passionate about property over that period, and started doing a lot of research and started really researching and reading as many property investment books as I could. And I bought the first investment property when I was 18 years old. So went from there.
Wow. So you caught the bug. And I mean, what was the hardest part of getting started back then? Were you working pretty hard and saving pretty hard?
Yeah, definitely. Like probably the hardest part was just buying the first one. And I think that's the same with a lot of people. I worked at McDonald's from like the age of like 14 years old while I was still in school. And by the time I was 18, I would save a couple $100 a week. So I had at the age of 18, I had just under about $20,000. And still working at McDonald's at the time, my borrowing capacity was like literally nothing. So I went to the multiple banks and couldn't borrow anything, and everyone would just laugh at me. So yeah, the first one was definitely the hardest, and just saving that deposit, because when you're a young, and even if you're not, you don't have to be 18 like the age I was, but even if you're 25 or 28 or 30 or whatever, it's still just hard to knuckle down and put that money away, because you just spend it on just stuff, and money just flies out the door. And the older you get, obviously the harder it gets as well. Your expenses start to grow. So saving that money is the hardest thing for sure.
Yeah, that's a great one. And I think a lot of young, aspirational property investors will probably get stuck in the same thing, and they're probably even in the same boat that you were, working at Macca's or a fast food restaurant and trying to figure out a way to get into the market, but just seems that they can't because of the lending environment at the moment. And so, I mean, how did you kind of overcome it? What sort of property did you buy? What sort of price range? And how did you eventually get that loan across the line?
Yeah, so the first one really came down to a lot of different things, but I guess like trial and error initially. And like, because I grew up in Western Sydney, about 45 minutes an hour out of Sydney. So I grew up in sort of called Mount Druitt, which a lot of people know as being like the roughest area of Sydney. And like growing up in that area, like that was my driving factor for wanting to buy a property as soon as possible. So as you can imagine, back then I first started looking around the area, but around back then even it was a lot cheaper than it is now. But I still couldn't afford anything at that price range. So I looked in other areas that I knew of that was still relatively close to the same state, of course. So my family used to go up and holiday around the entrance and around Central Coast. So that was the second place I knew. And fuel is today, but at that time it was a little bit cheaper than Western Sydney. So I started looking, after realising I couldn't afford anything in Western Sydney, I looked at the Central Coast. And I eventually bought a 2-bedroom unit, and it was just a 2-bedroom unit in a block. There was only about 10 in that block, so it wasn't a big unit block or anything like that. There was only 10 in there. And that one I picked up, it was an urgent sale, and this was around 2010, so it was 10 years ago now, roughly. I picked that one up I bought it for $138,000, which is super cheap, and it's almost tripled in value since then over that 10-year period. So luckily I bought it at a good time, which I didn't know at that time, but I bought mainly because it had a really high rental yield. The yield that it was rented at the time for about $200 to $220 per week. So even at that time, after doing years of research, I knew that the yield was about 7.5%, and it was in Central Coast, so it was close to shops, schools, etc. And that was what my borrowing capacity was at. So I only had a borrowing capacity of like 140K, which was next to nothing. So I was pretty much, due to lack of options, I couldn't buy in Western Sydney at that time. I've bought in Western Sydney since then, but I looked at the next place I knew of, which I felt comfortable with at the time, which was the Central Coast. And I really wanted a house first, as everyone does, but I bought a 2-bedroom unit, and it's definitely paid off. And I think it's the same goes today. It's better to just start small and work your way up.
Yeah, it's all about getting into the ladder and taking that first step. Depending on where you are and how you sit and what you can borrow, it's always about getting in there. I mean, if you can't save faster than property prices are growing, you're better off getting in and riding that capital growth wave until you've got a big enough deposit to buy some of that A-grade property that you're obviously hunting down now. So by my calculations, you're 28 now. If you bought when you're 18, that was 10 years ago. Are you 28, and how does your portfolio currently look?
Yeah, so I'm 28 years old. At the moment, I've got 16 investment properties under my belt. I'm trying to buy a few more at the moment. So my goal is to get another 4 by the end of the year. So by the time before I turn 29, I want to have 20 by the age of 28, basically. So I'm on track to do that. I'm trying to restructure some of my loans at the moment, and really want to pick up another 4 properties over the next 6 months or so. But yeah, I've got 16 properties at the moment. They're all rented out. I've diversified those properties in Sydney, in Brisbane, Gold Coast, Adelaide, even Cairns. So
wow, you
got 5 different areas.
Big portfolio of diversified properties there. So talk us through, I mean, was it sort of a compounding effect of the number of properties? Like how long was it after you bought the second and third, and then did you start buying 3 a year or something like that?
Yeah, pretty much. Like the first one I bought around 2010, roughly. The second one probably was the biggest gap between buying properties, because after the first one, I was 18, 19-ish. I did what a lot of people that age do, which is just go out, party, drink a lot of alcohol, and do that kind of stuff. So I didn't really do much after the first one for quite some time. I was just kind of became a bit of a party animal for about a year and a half to almost 2 years. It was only after a year and a half which I started getting, I guess, interested in property investment again. And it was just, maybe I had a little bit of that partying out of the system. But then I started reading more property investment books. And there was also like different magazines out there, like Your Investment Property and Property Investor, etc., where I would occasionally see there would be a few other investors or something, this is going back 8, 9 years. But I'll glance at those magazines and I'd see people that had 4 or 5 properties, and they were only in their mid-20s. And I'm like, wait a minute, I'm 20 now and I've only got one. These people are only a couple of years old, and they've got more. So I guess that's when my competitive streak kicked in again, and I realised that one property isn't really going to make you rich, or isn't going to make you poor, isn't going to change the world, but you need to continue growing. So after that, I chose to get aggressive again. I bought property number 2, which was a house that was in Adelaide. My dad actually lived in Adelaide. That was around 2012, I'd say 2012, 2013. So about 2 years after I bought that first one.
Yeah, that's awesome. And I mean, it's to go on from there, I want to talk about it a little bit more, but I think, you know, the statistics are still 95% of investors only have one or two investment properties. I can't remember the exact statistic, but I think a lot of people, what I'm trying to get at is a lot of people get stuck on trying to get past that second or first investment property, and they don't really know how to get there. So talk to us a little bit about, you know, how did you overcome getting past the second one and then obviously getting to 16 now? Is there sort of a strategy that you put into play, or is it just purely a financial game?
Yeah, like every single property that I've bought always has to meet three main criteria anyway. One is really having a really high rental yield. So it's got to be able to at least take care of itself. And I've bought properties since then that have been positive geared, neutral geared, some negative geared. So I guess it's a balance. Like you don't have to go all actually positive geared extreme amount, because obviously if you diversify in areas like Sydney and Melbourne, they're not really going to be positive geared most of the time, you know. So I guess it's about having a good balance. But the first thing is definitely having a high yield and focusing on that more than anything else. And second thing would be just picking up properties that are actually below market value. So like always looking at comparable sales before making any purchase. No matter what I'm buying, I've got to look at and compare it to what has recently sold up a similar comparison. So where a lot of people just filter on realestate.com, filter on Domain, chat to real estate agents, and they look at what's the cheapest thing on the market. Really, even back then, I'd always look at what one had sold and then try to get it below what all the other ones had sold for, that kind of grey area. And yeah, so buying below market value would be number two. And I guess the last one is definitely just buying in a metro area where there's growth potential. And I think that every metro area has growth potential. So the two main things you can really control is the yield and buying below market value. That's that I've really stuck to over the last 10 years.
Yeah, that's an awesome strategy, and obviously it's worked since you've got 16 of them. And there's no, I mean, there used to be some old methods where you could, you know, set up multiple different trust structures and get a new loan under each individual trust structure and continue buying properties. And a lot of people talk about that as, you know, the old methods of gaming the system. But have you used that strategy at all, or have you just bought everything in your personal name and sort of rolled on from there and the banks have allowed you to do it? I'm just kind of, I get these two minds sometimes where a lot of people talk about, you know, buying just really good, larger assets that do compound capital growth over time and do really well over that 10, 20, 30 year period. And then I've got a lot of guys like yourself who've sort of built this multi-property heavy cash flow portfolio and, you know, somehow continue to seem to borrow more and more money. Is that the strategy that you've gone down?
Should you buy properties in like a trust structure is something I got caught on like after my third property, because I bought my first three in the individual name. After that, I spoke to a million people and everyone like, why don't you buy property in trust structures for asset protection and, you know, distributing income in the future and all that kind of stuff. And that kind of helped me out for a long time as well. And I guess long story short, I have bought properties not in my individual name. I've got a lot of properties in my individual name and my partner's name, individually each, which we bought together, but we've structured it separately for finance purposes to be able to continue borrowing more. It's structured them differently. But we've also bought in self-managed super funds as well. I'm trying to buy another one through self-managed super fund at the moment. But buying properties through trust structures, I haven't really, and I wouldn't really do that starting all over again, because generally there's just a lot more differences when it comes to the finance side of things, getting finance. And there's many pros and cons. So the majority of the properties I bought in individual name and under self-managed super funds, there's so many pros and cons with buying in trust structures. And I guess for me personally, I haven't really found it where the pros outdo the cons, basically.
Yeah, right. That sounds like you've had a few combination of different entities that you've purchased under, and that's helped you sort of cash flow or continue to borrow under different entities. So it sounds good and pretty interesting. So you talked a little bit about getting 20 before you're 28. Is that your sort of intermediate goal, but what's your end goal for property investing? Is there a certain number you want to get to? Is it, just to retire early? I mean, what's your sort of thoughts there?
I thought that I'd stop at 10 properties, and then I thought I'd stop at 15, and having 16, and I'll have 20 soon. So I know now I'll never stop. I was a little bit naive back then to think that I would stop. Even being able to retire essentially, I still wouldn't stop, because I guess it's for someone who does want to build a portfolio of either 3 or 4 or 5 or 6. Once a person does that and they get to that stage, generally most of them realise that even if they can hang up the boots and just quit tomorrow, generally no one does, because you always want to continue growing, and you just get, for lack of a better way of explaining it, you get bored. So that's why even all the super successful people in the world, that create $1 billion businesses and be billionaires and all that kind of stuff, they still do something every day, even though they don't have to work. Warren Buffett, Bill Gates, and all that kind of stuff, they still continue to do stuff and build stuff no matter what. So I don't think I'll ever stop. I don't think there's really a number that where I will stop. I know I'll definitely hit over 100, probably 200, 300 properties sooner or later, and eventually, but I don't think there'll be a magic number where I'll stop anymore, which I used to think I would. Yeah.
So just continue adding to the portfolio. That's the end goal. Probably pass on a legacy to the next generation if you choose to do so. No, that sounds really good. It's really interesting. It's good that you're sort of, you know what your passion is, your drive is, and if you continue to do that and help others through your business every day, that's what brings you sort of satisfaction in your life, I guess. I think you're spot on with all those billionaires who sort of, they could retire if they really wanted to, but it's the process that they've fallen in love with, and they continue to do it every day. And I think you eventually get to that point where you sort of, you're working 9 to 5 to pay the bills, and then you eventually down the process that we've gone down is, you invest in with your additional cash flow, and then on top of that, you build your wealth until you're at a point now where you're like, okay, well, I could retire, but what do I want to do every day with my life, and try and figure that out. So it seems like you got it down packed and sorted, mate. So tell us about your most successful deal. What's the best deal that you've ever done, and give us some of the numbers and the strategy that you used.
There's been a few. I guess one of the most recent ones that I think has been successful is actually, it's probably the property that I currently live in now, to be honest, which I wouldn't really say it's an investment property because it's owner-occupied at the moment, but eventually we'll rent it out and upgrade it to something bigger. But one of the, it was basically a large property in West Sydney, so it was, not too far from Parramatta. I picked that up basically about 12 months ago. At the time, a little bit of the numbers was me and my wife were basically looking for a property to live in and eventually upgrade, in 3, 4, 5 years' time, and get something, maybe on the beach, etc., and continue upgrading as people will usually do every 5, 10 years. But this one, we just wanted something that would eventually rent out, but would act as an owner-occupier for 2 years, 3 years, 5 years, etc. And it was basically like it was a property in the western suburbs, and we picked it up for $740,000, so $740K. It was initially listed online for about $950K. I think it was initially listed on realestate.com at $980. So just under $1 million. And the owners who actually owned that property had already committed to another purchase. They had the property for 10, 15 years, so you can imagine where their loan would have been and what their equity position would have been. So they didn't really need to. Since they already committed to the other purchase, they had the money to basically do it. Just needed to offload this property and clear the debt. But due to, I guess, at the time of the market, it was probably in that trench where Sydney market had come down after the big boom, and it was right before the whole negative gearing. Everyone was scared about negative gearing getting removed. So during that period of I think there was a lot of media going on about interest rates and negative gearing. Everyone was scared it was getting removed. I personally all markets were at a very much standstill. There wasn't much really happening. Everyone was waiting till after the pretty much the news that this negative gearing was getting removed. So it was during that time period, and at the time, like I saw it as a time to pretty much strike because everything was at standstill, and I knew that it didn't really matter if negative gearing got removed or it did. But that price pretty much dropped twice, and then I managed to get it from the 980 to the 740, and that was within 12-month period. I got it valued at pretty much $1 million, but I bought it only for 740. So it was almost about 25% increase within 12 months, and $250,000 within the 12-month period, basically. So
that's crazy.
That was just the fact of buying, when everyone was really scared to buy, and also looking at the sales and doing a lot of research.
Yeah, that's a perfect example of be greedy when others are fearful and fearful when others are greedy. And that was a great time in the market to buy. I think I purchased the weekend after the election had finished, and it's the same scenario with me. The market was still low. There was still low consumer confidence in the market, and as you say, there was so much negative media feedback. And even for the previous 2 years, there was that 60 Minutes video, which was like the market's going to drop by 40%, blah, 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 blah. So there's so much negativity in the market and not much confidence from normal buyers. So that's a steal, mate. 740 and they've gotten revalued at $1 million. It's no wonder that you're able to continue buying properties with that sort of returns, 25% in 12 months. So I love it. That's a great deal. So, going into buying all these properties, how do you assess the potential of a property?
I guess assessing the potential, I really take a lot of all emotion out of it. I haven't just stuck to houses. I have bought townhouses. I have diversified in some units occasionally as well. I have bought really low entry cost properties. I've bought properties in Brisbane for $100,000 flat, like a unit and townhouses and stuff like that. I bought properties in Adelaide for $150,000, $200,000, and the Central Coast and all that kind of stuff. So I don't really. I always assess. I first start on the outside and look at if it's properties in a metro area, talking Sydney, Melbourne, Brisbane, Central Coast, whatever, and it's within an area that I'm not buying out in multiple poor regional towns or anything like that. We're regional, major capital city hubs like Sydney, Melbourne, Brisbane, that kind of stuff. And looking at the lower end of the market, whether it's maybe a house for $350,000 and under, or $400,000 and under, and townhouses and units, etc. Those are going to be long performance. And I really simplify stuff by thinking, hey, look, I'm really young, I'm 28, and I've got 10, 15, 20, 30, 40 years. Because most people get started, unfortunately, at 30 or 40 or even later sometimes. But I think I've got more time than most people do. So I'm not afraid at all to start and pick up those, lower end properties that have the really high yields in those metro areas and diversify in all the metro areas, because I'm going to be able to hold them for the next 10, 15, 20, 30 years, as long as the rents are high, which they always are. So, and I try to stay away from when a lot of people talk about carry on about hotspots. What I firmly believe is that growth ripples from market to market, and there's markets within markets, which a lot of people know. But let's take Sydney, for example. When Sydney went through a big market cycle, all areas of Sydney within a 50-kilometre radius almost had the same percentage of growth rate, almost. So Bondi might have went from $1 million to $2 million, but then Penrith went from 300 to 600. Same rate of growth, but most people think the blue chip ones go up more in percentage, when really they're pretty much the same. There might be a 0.12% difference, but people just see the bigger capital gain, the bigger number, and assume it's gone up more in percentage, when really it hasn't. So no matter where you buy within that area, it's going to experience a growth ripple effect. If it's got construction going on this side and you invest 20 kilometres away, it's still going to have a ripple effect no matter what. So I really try to take a lot of that, emotions side out of it.
Yeah, that's
if that
perfect.
makes sense. So,
Yeah, 100%. I couldn't agree more. I think, you know, on hotspotting as well. Like once you hear about the next greatest hotspot, it's generally too late. Like they're only saying it's a hotspot because they've seen all of the new data come through and analyze it and say, oh, you know, this place is going off. And then because they've released all this sort of media and made traction about it, there may be a bit of manufacturing equity or capital growth in that area because everyone now thinks it's a new hotspot, but it's generally too late.
too late.
I think you're spot on there, and I love that. The market flow on effect. Like that's a big one that I've noticed in my journey too. Is you know, you're buying close to these affluent areas, and eventually those affluent areas become too pricey for, you know, your everyday, you know, double income family dinks to buy in, and they sort of flow on to the next suburb because they still want to be in the same area but close to families, or, you know, still relatively close to commute to schools and cities and all that sort of stuff. So yeah, I couldn't agree more, mate. I think you're spot on there. So is that part of your sort of risk strategy, is staying close to those areas? I mean, is there anything that you've got in plan for an exit strategy or anything like that?
Yeah, look, definitely always staying in metro areas is part of that. Yeah, and diversifying in the different states and all that kind of stuff. Like we've got properties across a fair few states now. Eventually I'll buy properties in Brisbane and Perth, and that kind of stuff as well. But like exit strategies, like I guess, yeah, if you buy properties that are below comparable sales, below market value, I see that as an exit strategy. Like you can pick it up 30K below what you know someone else will be buying for. If you need to offload it, you're still going to make a profit, or at least get your money back if push comes to shove and you need to sell it, because you're picking up below what the value would be. So I think as long as you buy below comparable sales, it's the exit strategy in itself for all the properties.
Yeah, 100%. You've sort of mitigated your risk from the get-go, really. If you're buying significantly under market value and you know you can secure or manufacture some equity or something to try and bring the value up. So even if you had to sell it, worst case scenario, you're still covered. So that's a great one. I mean, have you made many mistakes during your journey? And if so, what do you reckon your biggest mistake is?
Yeah, definitely. I think I've made mistakes, but I think the only thing I could say would be my biggest mistake is not buying more. Like I've had opportunities where I did buy more, where I could have bought more and I didn't. So like I could have bought more properties in West Sydney, you know, 6-8 years ago, but I didn't because I'd negotiate them, and then, you know, I'd be worried about very insignificant things, and that's something that I see. You know, I talk to people about it, you know, all day, every day now, is people sweating the small stuff. Like I'd do an inspection and then I'd get hung up on something cosmetically wrong with the kitchen or the property, and I'd want, you know, the pest and building to take an extra $2,000 off because there was a issue with something here or there. So I pull out the whole deal out of $2,000, and now I look back 6 years later and it's got worth 150K more, and I didn't buy it. So kicking myself. So yeah, when it comes down to all the minor stuff with minor property, like I don't focus on it at all. Whether like I speak to people now and they're like, "Oh, is the property tenanted?" And I'm like, it doesn't matter if the property's tenanted. Like, I don't personally care at all, because if it's in a metro area, you got the right property manager, you got the right procedures in place. You wouldn't be buying it if you couldn't get it tenanted. So it doesn't matter if it's 50K below market value. Would it matter? Would you still buy it if it's not tenanted compared to if it was tenanted? Like, would you say no to 50,000 because it's not tenanted? Like, it just, so all that small stuff, as I built my portfolio, I realised it just didn't matter. That comes obviously with more properties that I've bought, more confidence I've gained. But in the beginning, it's hard to be confident when everything's new, I guess.
Yeah. So it's less about buyer's remorse for you and more about opportunity costs, really. There's all these other opportunities you could have taken, but I still really want to pick at this finance strategy, because I think, I mean, I'm at that point now where, you know, I'm on a good salary and I think that I could be or should be able to borrow more. And I mean, it might just be the current lending environment. But do you have like a specialized mortgage broker that always gets you deals? I mean, how do you get around being able to borrow more and more money all the time?
I guess a few different things. Like I've used brokers and I've used banks, and there's no right or wrong. They both have their ways to, brokers can obviously give you a bunch of different banks to move forward. But like I got up to like 8, 9 properties, and I was on average income. I was probably on lower than normal. So I'm generally every property I've bought has always had a yield above 7%. Generally, every single one, no matter what. And I guess as long as the rent, I'm not in personal circumstances, but as long as the rent covers everything, and like it's either an issue with the equity or it's an issue with the servicing. So if it's an issue with the servicing, then it depends on the person's situation of how much expenses and rent if they pay rent, or mortgage if they pay mortgage, personal loans, car loans, etc. But like if a person's on average income, let's say a person's say on 70k, 80k, or whatever, and their borrowing capacity is 500k, I know now that a person can stretch that. Generally, that 500k is probably like 2 million if they play their cards right through different banks and strategically do it. I started off with the big banks such as like Commonwealth, St. George, Westpac, those kind of banks first, and I maxed out with them. So like after I bought like 8 properties with Commonwealth and St. George, eventually they both just cut me off and they said you can't borrow anymore. And when most people would think I'm stuck at 8 or 9, and I got stuck at 4, I got stuck at 7, I got stuck at 8, but this was servicing, so like with borrowing capacity. But after that, I just went to other lenders such as Liberty, Latrobe, Kepper, and they still said I could borrow at 400k. So I guess I learned along the way that every single lender has their own servicing calculator, depending on the bank. The big banks of if I would start again, I'd definitely hit the big banks first because they're more lenient with valuations and timeframes and investors in general, and getting equity out. But those other smaller banks, like the third tier, they will generally give you a higher servicing rate. So I have left those for last intentionally. And when I got stuck on my personal name, I would buy under my partner's name together, but technically we weren't married at the time, so they would be only under her name, as an example. So we'd own them together, but they're under someone else's name. So then it's a whole other person there buying property that's not you, but it's still your property technically.
Yeah.
And then so there's another way. And then I bought I was probably the youngest person to buy a property through the self-managed super fund. I only had 35 grand in my super, and I used that to buy an investment property. So I rolled my super over to a self-managed super fund, had 35k in there, dumped about 20,000 in there, brought up to 55k, and then after the super was rolled over, I used 55k in the self-managed super fund to use it as 20% deposit to buy another investment property through that, because that's totally different service. That's totally different servicing altogether with the bank. There's different borrowing capacity compared to what. So you could probably do that yourself.
I was just going to think that. Like I was looking at my super the other day, and there's a significant amount in there, so maybe I will think about doing that. And obviously this is not financial advice or anything, but is it like a brand new borrowing capacity? Like, does it reset? Is it like a new entity?
Look, essentially, how it works, obviously not a mortgage rate, etc. But how it worked for me, like I couldn't service at the time on my individual name because this is just from my knowledge. They did my servicing based on what income. So say someone's on, 70k as an example, and then they would just be serviced on what super contributions they get per year. So plus the rental income. So they look at your income and other properties you've got, but it is a totally different ballgame in terms of your servicing calculator. So if anyone's stuck, I've seen people that are totally cleared out. They can't buy any more than an individual name unless they get a pay rise, and then they buy super, and they can borrow 400k. So yeah, it is very much different from my experience. I'm trying to buy another one for super at the moment, or I'm trying to prep to buy another one through super. So I can definitely do it for sure.
That's cool. And talk to us about your preparation. I mean, is it a big process for you? How long does it generally take? I mean, what are you doing now at the moment to sort of set up for that?
With every property, like you'd experience this, the more properties you've got, the more harder it is to actually get an application done for finance. So you've got to have like every single rental statement, every single bank statement, every single loan statement. So you fill out like a broker fact find, or you fill out the application with the bank, and you've got to list every single asset liability you have. And it is just a nightmare to do. The more properties you get, it takes forever for something that can be knocked back, and a complete waste of time. But that's just property investing, like half of it's heartache and tears, and the other half is the good part.
Yeah, that's awesome. Oh, that's interesting to know. Like, yeah. I mean, even with two now, I'm sort of in the same boat. Like, there's so much to have to go. I bought my second one under a trust structure, and there's so many more complexities having it under that separate entity as well. So I can just imagine the process that you have to go through for 16 of them. That's phenomenal. So, I mean, what resources do you use to try and scope out properties? Is there a specific online tool, or do you talk to professionals in the industry? I mean, where do you go when you're personally scoping out property?
Like 9 out of 10 properties that we get, that I pick up today, they're generally off market, so they're not really on real estate or domain. They're through, I guess, agents that I've bought through before. Sometimes even like public trustee, like bank administrators that I've bought through before. So I'd say 9 out of 10 aren't really on real estate.com. Occasionally you pick up a couple, but doing like what resources are you used to actually look at the property address and compare it with comparable sales, mainly like RP data. You have to obviously, like real estate agents generally have RP data, you've got to pay, $2, $3, $4 grand a year, depending on what subscription you get to pay for that kind of. And in the beginning stages, I didn't use that. Like you can find a lot of stuff on the real estate domain. But yeah, nowadays you use RP data to mainly draw reports and look at comparable sales, find out exactly when a property was sold, because online sometimes prices withheld and all that kind of stuff. So yeah, mainly RP data.
Yeah, that's awesome. And obviously that combination of off the markets and all that sort of stuff, and then you do your research on RP data. That's a little secret combo there. So, I mean, what you sound like a pretty motivated guy and ready to jump onto the 300 property ladder. But what does motivate you? Like, what gets you up in the morning?
I guess like the motivation is just, I guess it is a little bit of a tough one. Like it's just a constant progression, I guess, for me. Like I'm way further past what I thought I would be. For me, I came from like extremely poor family, so like a level of poverty in the area, and like even the family that I grew up in was extremely high. No one I knew even growing up even owned a home. Like that wasn't a normal thing. Even having a job wasn't really a normal thing. It was more like a normal thing for me was being on the dole or something like that. So or like, and even in school, I didn't even know what a university was. Like that's how, like, thinking back, I'm like, who doesn't know what university was? But even that school, I didn't even know what that was. I barely even passed school. So I guess for me, it's just constant progression. Is trying to always hit the next level and continue getting better and better. Really, like
Yeah, that's awesome. No, it's good. It's good. You hear a lot of stories like that. Even like Tony Roberts and stuff, and they've had tough upbringings, and they sort of feed off that motivation and drive to get them to new places and help other people, which you're doing through your business, which is phenomenal. And just finally, I mean, what advice would you give our generation on getting started?
Yeah, I think some of the best advice I would say is just start off really small. Not really small, but start off small. And even if you can buy a property for $1 million, it doesn't mean you have to. You can start off with something for $400K, $500K, $300K, whatever, just to gradually build up. Because property investment's a long game, and you've got to really do your research as well. So like I would definitely say start off small, read as many property investment books as you can, listen obviously podcasts like this, and just always question everything that you've been told as well. Because like I speak to people and they said do this, do that, and they owned like one property, like, or they didn't own any property. So looking back on it now, like they were in no position to be giving advice, you know. So like when I was at one property, I would try to find someone that had 2 or 3, and not many people I knew at the time did. But you know, even today, like I would only take advice from someone who had 50 or 100 properties or whatever. So yeah, always, no matter where you get your information from, I guess make sure it's credible information.
Yeah, that's spot on, and that's exactly what I'm doing to you today, mate. I'm trying to get to your level, so I thank you for letting me delve in a little bit further and figure out how you got there. But I really appreciate you coming on, Eddie, and sharing your story and some of the finer details and you know, the strategies that you've used to put in place to get where you are today. And I've got no doubt in my mind that you'll get to 300, mate. But thanks again for coming on. I really appreciate it.
No, my pleasure, Jordan. It was awesome. Thanks very, very much.
What an incredible conversation. Being a very strong in favour capital growth guy myself, I've been very excited to talk to Eddie about how he's been able to use cash flow to keep adding to his portfolio. And boy did he deliver. I hope you took a lot out of this episode, and I really appreciate Eddie coming on. I'm always looking for more guests to come onto the show. If you're under 30 and have 1 or more investment properties, whether it's good, bad or ugly, I would love to talk to you about it. The main focus is to help other soon-to-be young investors with tips and tricks along the journey. Learn from the mistakes that we have made and ignite the fire to set themselves up financially for the rest of their lives. If you're interested in sharing your story, you can go to jordandeong.com/podcasts, where there's a podcast inquiry button at the top that will guide you through the next steps. Also, if you want to see what else I'm up to, you can head over to my YouTube channel to see the latest. Just type Jordan De Jong into YouTube and I should pop up somewhere. If you're keen for more content like this, make sure you subscribe and please leave us a review with any feedback for future podcasts. And until next time, happy house hunting.